The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone and welcome to our webinar. My name is John Carvello and I'm the co-founder of Divestopedia. I'd like to begin by thanking our webinar sponsor Firmex. Firmex is a global provider of virtual data rooms, helping to run over 10,000 new data rooms a year and trusted by over 75,000 companies worldwide to keep their documents safe. Divestopedia and Firmex are currently conducting a survey and industry report on M&A fees. We will be sending out a link to all registrants, and I hope you can find some time to complete this quick survey. We have a great topic for our webinar today. We are going to explore M&A fees in sell-side transactions ranging in enterprise value from $10 to $100 million. We will cover a number of areas on the topic with our guest, and in the last 15 minutes of the webinar, we will be answering questions from the audience. So feel free to submit them as we go along. For some reason or other, this is not a topic that is often discussed. I'm excited to have Basil Peters as our guest today to share his views on this subject. Basil and I have already had spirited conversations on this topic, so I'm sure that there will be lots of comments and questions. Basil is the CEO of Strategic Exit Corp, an M&A advisory firm. He has been CEO for technology companies in Vancouver and Silicon Valley. Basil is the most referenced authority on the subject of M&A fees. He has been collecting data on M&A fees for almost 2 decades. Part of his personal mission is to help make the M&A industry more transparent. Hello, Basil, and welcome.
Good morning, John. Morning, ladies and gentlemen.
Yeah, we have lots of information to get through today, so I'm really excited about the topic. So why don't we get started, Basil?
Thanks, John. Thanks for joining us this morning. Today, I'm going to try in about 45 minutes to give an overview of the research that I've been doing for, as John said, almost a couple of decades now on mid-market M&A advisory fees. We live and work in a competitive industry, but as John said, it's not very transparent. I think a similar situation exists in the accounting industry for audits. I've been on far too many audit committees and many times have brought in 4 large accounting firms to provide a quote on doing an audit for a company. The firms always come out, they ask a lot of questions, spend a lot of time, and then provide quotes that are usually within 5 or 10% of each other. And to me what that says is that their industry is also very competitive. And even though those accounting firms know exactly how to price an audit, I'm still surprised that you can't go online and read about how to price an audit. They're just not very transparent in explaining how their pricing works. And it's exactly the same in the M&A industry. There's very little written on M&A advisory fees for the mid-market. And part of my personal mission is to demystify and to debunk the M&A industry. I've been collecting data on M&A advisory fees, sell-side fees for a long time. The way that I do this is whenever I get an opportunity, I ask a fellow professional in the industry or a friend who's a CEO to share with me on a confidential basis what the fees were for the transaction that they're either proposing or the pricing model that they use in their firm. And for a long time, it was hard for me to understand the differences that I was hearing in the numbers that I was getting. And it took me quite a long time, many years, to put these variances into perspective. And that's what I'm hoping to share with you today to help you understand how the pricing really works in this competitive industry. And I want to emphasize that while we can find big databases for large M&A transactions where the fees are often disclosed because companies in large transactions are often public, they have to disclose. So if you're talking about M&A fees for multi-hundred million dollar transactions, you can find statistically valid data sets that will help you understand how the fees work. But there is absolutely, I'm sure, no database of mid-market M&A advisory fees. That just does not exist anywhere. And what that means is that the best information that we can get, the information we have to go on, whether we're a sell-side firm or whether we're a business owner wanting to sell, we have to rely on anecdotal information. And what that means is conversations, it means informal data, and usually that kind of information is available from webinars like this or from presentations at conferences. And again, I want to emphasize, as John said at the outset, what we're talking about here is transactions in the $10 to $100 million transaction value range. Another important consideration when you're thinking about a range of topics in our industry is that the mid-market M&A industry is completely unregulated, and there aren't even recognized credentials to work in this industry. And that's quite different than most of the other professional service industries we're familiar with, like accounting, legal, engineering, and the health professions. And I personally am convinced that some people who didn't succeed in the used car industry are now working as M&A advisors. And the reason I make that point is that in our business, there's an enormous range of qualities of service being offered in the market. And that's an important thing to keep in mind when you're comparing the fees that you might hear about or the fee quotes that you might be getting to sell your business. There's a number of factors that affect the quantum of the M&A fees for a particular transaction. One is that different transactions have varying levels of difficulty and risk. Different transactions have different numbers of prospective buyers. There are also local market factors that affect the fees, and the fees vary with the macroscopic M&A market. And the biggest factor is the quality of the M&A advisory service connected to a given fee. To expand on each one of those quickly, some transactions are definitely more difficult to execute, and they're certainly higher risk. On the one end of the spectrum, a business that has over 5 years of steadily increasing EBITDA over $2 million is relatively easy to sell and low risk. Conversely, a business with no revenue and a valuation expectation in the tens of millions is a very challenging transaction to execute. Another example of how transactions can be different is that while I don't have a lot of data on this, I believe that a business owned by a private equity firm is 2 or 3 times easier and lower risk to sell than one owned by a founder. I could talk for a whole half an hour on why that is. But it is a way that you might see, you might meet a private equity firm, they might tell you M&A advisory fees that are much lower than what a founder might be quoted, for example. This is, again, one of these nuances in the industry that you've got to take into consideration when you're trying to make sense of the fees in the marketplace. Another factor that has a big impact on the size of the M&A advisory fees is just the number of buyers. In some transactions, there's only one buyer. That typically happens when a company gets an unsolicited inbound indication of interest. Then they go out looking for an M&A professional to help them, and through the whole process there might only be conversations with a single buyer. On the other end of the spectrum, a fully marketed transaction could involve research and contacts to literally thousands of prospects all around the world. And the difference in the number of man-hours required to do those two can easily vary over a range of 2x to 4x, primarily because of the time spent doing the research and the time spent having conversations with several hundred or perhaps 1,000 different buyer prospects. And of course, this is a professional services industry. The fees will vary in direct relation to the number of man-hours required in the transaction. Another thing that took me a while to see in the market was that M&A advisory fees vary geographically. And of course, our industry tends to have a regional focus where M&A advisors typically work closer to the companies that are being sold. And some markets are oversupplied. And by that I mean there are more M&A advisors than the market really needs. And examples are markets like Seattle and Toronto. And I don't know why it is, but there just seems to be too many M&A advisors in those cities. And what happens then is the markets become hyper-competitive. Companies will often find, 5 or 6 M&A firms who want to bid for the transaction. And the inevitable result in those cases is that the fees get driven lower by that hyper-competitive market. It's even possible, I think, to see that fees are lower near the downtown core in especially these markets that are oversupplied. Another factor that's quite a significant factor these days in the last 5 years or so in the market is that the M&A fees that I see out there have been changing with supply and demand. And I think over the period of roughly 2012 to 2016 that M&A fees increased by approximately 1 to 2% of transaction value. And that's a lot when you consider that the fees are typically a single-digit percentage of the transaction value. So if we're talking about a fee in the 4% range, a 1 to 2% increase is a 25 to 50% increase in the fee in that case. And this seems to me to have happened because the macroscopic M&A market has heated up significantly during that period. And what's happening out there now and has been for the last couple of years is that most of the good quality M&A firms are operating at near capacity. So as their ability to deliver starts to become constrained, it's natural that they tend to quote higher fees and optimize the profitability of their business. But the most difficult, and I think the most significant factor that we need to consider when we try and understand M&A fee pricing structures is the quality of the service. And when we go back to the example I started out with the audit from a big accounting firm, the quality of an audit, in my opinion, might vary plus or minus 10%. In other words, you can hardly tell the difference between the result of an audit from any of the major firms. But in our business, the quality of an M&A service, I believe, varies over at least plus or minus 50%. And if you look at some factors within the various categories of quality, it's actually much more than that. And so for the purposes of this webinar and what I do when I'm having conversations about this at conferences is I think of it as a bronze, silver, and gold level service. Not unlike a lot of other services that we can buy. There's, average quality, there's the economy version, and then there's the really high quality version. It's the same in the M&A industry, perhaps more than in other industries. One of the things that I think is perhaps the most important factor when comparing services and quality of services is the probability that the M&A advisors will succeed in completing a transaction. And based on many years of trying to understand what's actually happening and probably hundreds of conversations, I believe it looks something like this. And this is usually a surprise to people when I first show them something like this. And I've had lots of quite fun conversations at conferences about this. But I know for certain that there's a large M&A advisory firm out there that I'm sure most of you are familiar with who measures their success rate like most firms do and has a success rate of 8%. And I know this because I've had conversations with people in the firm. I even have 2 emails from people in this firm that confirmed that their success rate was 8%. So what that means is that 8% of the time when they sign up an engagement and receive a work fee or a retainer fee, they sell the company 8% of the time. And I also know that there are good quality firms in major markets like Chicago and New York. If you're a business owner and you go to these firms and they're pitching you on their service, they will say quite proudly that they sell 30 or 35% of the firms that they are engaged by. And they say that because they know that's not an unreasonable success rate. But I also know that there are boutique firms that actually have success rates in the 65, 75, possibly even 80% range, again, depending on exactly how you measure probability of success. So from the client's perspective, from the business owner's perspective, there's an enormous range of qualities just on this one factor, which is the probability of success. And so let me give you an example that tries to illustrate the range of fees that are associated with the different service quality levels and one other factor, which in this case is the number of buyers. So on the vertical columns here, I'm comparing a fully marketed global search that might involve hundreds or perhaps even 1,000 or more prospects, and contrast that to a limited engagement that would only consider 3 or 4 buyers that are probably identified in advance. And this is a summary from an article on my blog that is actually the most referenced source in the world on mid-market M&A advisory fees. Not because it's particularly an excellent piece of work, it's just that it's the only article out there that actually has any data on this. But then in the rows, I'm showing the differences that I see in the market between gold, silver, and bronze. And this is all for a transaction in the $20 to $30 million range, roughly. So in the upper left, for a fully marketed global search and a gold service level, I'm seeing fees in around the 7% range. And I say around because that's probably plus or minus 1%. So for gold, fully marketed, it probably varies from 6 to 8% is what I'm seeing for a $20 to $30 million transaction. But in the lower right, if you limit that search to only 3 or 4 buyers, and if you provide only a bronze level service, the fees I think you'd be getting quoted are probably a quarter of that, probably around 1.75%. So, you know, somebody who's got a $20 to $30 million company is going out interviewing M&A advisors, being very careful about specifying the number of buyers. They could be seeing success fee quotes ranging from 1.75% all the way up to 7%. So quite a big range because there's quite a big range of work and quite a big range of quality involved. Let's continue to talk about this quality factor a little bit more, and let me drill down one level and show some of the factors that are involved in the different service levels. Now I've got the service levels across the top, bronze, silver, gold. You know, one of the things that makes a difference, and I describe this in more detail on my blog, is that different M&A advisory teams, sometimes even within one firm, just have different qualities. You know, there are some really expert individuals in this industry, people that have been involved in maybe 100 transactions and they're good at it. And there are always those new graduates, newly minted MBAs trying to break into the business, trainees if you will. So there's a range of qualities just of the team. There's also a huge range, and I'll talk about this some more in a minute, in the number of man hours that a firm will budget to work on a transaction. I'm showing it here in man years. A man year is roughly 2,000 man hours, basically the number of hours you would work in a year. What I'm seeing in the market, and when I talk to other M&A advisory firms, I'm hearing that, you know, bronze level might be around a quarter man year, silver might be around 1 man year, and a gold service level might be 1.5 to even 2.5 man years. So a range of almost 10 times in the number of hours that different firms will devote to a transaction. And what that means to the business owner is that the probability of success will range from low to high. The price will also vary over a wide range. I'll talk about that again in a minute. And the deal terms will also be very dependent on the quality of the M&A advisory service provided. So again, to put this in perspective, you know, what I'm seeing out there in the market is that the fee range varies, let's say, plus or minus 3%. So somewhere between, you know, let's take a mid-sized transaction, maybe it's got a 5% success fee. That could range from 5 minus 3 down to 2, in other words, or 5 plus 3 up to 8. So a business owner, again, could be quoted anything from 2% to 8% to sell the same business depending on these quality factors. And here I'm showing graphically what I mentioned a minute ago, that the range in man hours that I see, that people that I've spoken to have told me that they will invest in a transaction, can be anywhere from a quarter man year, in other words around 500 hours, all the way up to 2+ man years, so as many as 4,000, 5,000 man hours of professional time. Again, depending on the quality and depending on the scope of the engagement. What this means to the business owner is that the probability of completing a transaction, in other words, after you pay the work fee, engagement fee, retainer, and after you spend a year or perhaps 2 years working, the probability of there actually being a sale of your business can vary from below 10%, believe it or not, up to 70 or higher percent. And again, an astounding range of outcomes that we don't see in many other businesses. I mean, in the audit industry, for example, I imagine if you engage a big audit firm to do an audit, the chances that it gets done are probably 99.9%. So most business owners, even people in the industry, underappreciate just how wide the range is on the probability of selling. We could do a whole webinar just on this one topic. There's so much here, so many interesting case studies on this. A little bit more difficult one to quantify, but a question that I get asked a lot by business owners is whether or not the quality will affect the time to closing. And I'm the least sure about this graph. You know, certainly if you put more people on the project, you'll tend to be responding faster, you'll tend to shorten the timeline. On the other hand, if you're surveying a larger number of prospects doing more work, there's a tendency for it to take longer. So on average, I think that you do end up with a shorter time to closing with a higher service quality, but there are some factors that actually tend to make it longer. So there's a lot of error bars on this particular graph. Deal terms is a really interesting one. This is very underappreciated, not just by the clients, the business owners, but also by the professionals in our industry. And there is no metric to measure the deal quality in a percentage basis. So when I've got plus or minus 50% here, I don't have any reason for calling it that, but what I'm trying to show here graphically is that there's an enormous range of deal term qualities, and that's affected very much by the M&A advisor and the M&A lawyer. I have seen engagements that have been signed and completed that have terms that are so horrendous. I personally believe that both the lawyers and the M&A advisors should have been sued for malpractice because the terms were so unfair to the seller. And the reason this can happen is that the seller has only their advisors to rely on to help them put into perspective what reasonable terms are in the market. And the knowledge and the ability to negotiate those terms is extremely variable. And I'm dismayed by some of the results that I see from the lower quality firms or the bronze level service packages. Because the terms can make an enormous difference. Those terms can literally ruin people's lives post-transaction. Another one that's very interesting to me is that in the financial services industry around the process of selling companies, there are some services that are offered for companies before they engage the transactional professionals. And there's no consistent term for these services. The AMAA Association is trying to help to define what these are called. Sometimes they're called exit planning services. Other times they're called growth strategy consulting services. But what they are is they're the services that are involved in getting a company ready for a transaction. And they're the things that are done sometimes for multiple years prior to a transaction to increase the fundamental value of the business. In other words, increase the financials, increase the intellectual property value, things that are actually making the business more valuable. And what I'm seeing out there is that for the bronze and silver level services, you don't get much of that. But in the higher quality service ranges or in the gold quality packages, I'm seeing different M&A advisory firms put in a considerable amount of work to help the business owners or help the management increase the value of the business before starting the transaction. And those could create, quite a big range of additional value in the business. I don't know, again, this isn't a very precise graph, but I think it's easy to see situations. I've been involved in situations where the business value has been increased by 20%, 30%, or even more because more time was spent, more professional time was invested, and the actual value of the business was increased prior to starting and completing the transaction. Another one that I see, I never see talked about, very rarely appreciated in our industry is what I call warranty work. And we don't have a definite term for this, but it is, I think, warranty work. It's work that needs to be done after the transaction is closed. And warranty work can involve all kinds of things. The typical situation is a dispute regarding the representations and warranties post-transaction. Those are very serious. Those usually involve many millions of dollars. A very common one that pops up, and I think I was at a conference and somebody said 40% of the time there's some work required to finalize the agreement on the working capital adjustment. And there's a range of other things that can happen post-transaction. For example, a disagreement on the earn-out calculation. Very common, most common reason for litigation in our industry. All of these things can be considered by different M&A firms as either in scope or out of scope. And what I'm seeing is that for the bronze level service packages, if there's any work to be done post-transaction, that firm is considering that billable hourly work. And typically firms will be billing that work out between $500 and $1,000 an hour. And other firms will consider that part of the package. Other firms will just consider that there's going to be some work that needs to be done post-transaction. In our firm, we find about 20% of the time there's a significant amount of work that needs to be done post-transaction. And this could be 10 or 20% of the total man-hours in the project. And again, in some firms that's included, other firms it's extra. I've rarely even seen this addressed in the M&A advisory agreement with the company. But an important consideration in my opinion, because if you're paying by the hour for this could be hundreds of thousands of dollars post-transaction, and a very difficult thing for the business owner to negotiate, because at that point there really is only one choice of the professionals to help. The switching costs would be very high to use a different firm, and very few firms would be willing to take on just the warranty work in a transaction. The easiest one, which is why I left it for last, is the price. And I've had some loud discussions with other professionals in the industry about this. I believe, and I actually have some examples of full case studies with videos of business owners on my blog, I believe that in most cases, not all, this is, again, I'm generalizing here, it's often possible to sell a company for 50% more. And the reason I know this to be a fact is that in many more cases than the ones that I'm fortunate to have up as case studies on my blog, there's been an initial offer, and lots of times I've actually had to almost sit on boards and owners and say, no, don't accept that offer. We can negotiate a higher price. And in the cases that I've highlighted and in many others, I've seen the price go up 50% and more because the transaction had been designed and executed to have a competitive final bidding process. And in that final bidding process, you really get an appreciation for how imperfect the pricing models are for the sale of a business. And it's very often possible to get 50% more just because of the skill of the M&A advisory team. And conversely, and much more disappointingly, I've also had detailed conversations and gotten far into transactions, none that we executed, but with friends and people that I know well, where I'm convinced that the company sold for half of what they could have received. And what's particularly dismaying to me is that in most of these cases, the business owners didn't even appreciate that they left tens of millions of dollars on the table. And they didn't appreciate what the real value of the business was, or what the strategic value was, or the necessity of having multiple bidders. And they closed on a transaction that was around half of what the fair value was for the business. And so what I often try and keep in perspective is that if you think about the range of fees that we started off on the first graph with, say roughly plus or minus 2 or 3%, and you think about the range of values that may be received for a given transaction, the range in the price received is about 10 or 20 times greater than the range in the M&A advisory fees. So those red arrows are where I try and describe the difference from the business owner's perspective in the bronze or low quality service compared to the gold or very high quality service. I think that graph really does highlight the range of service offerings available in our industry and the most easily understandable outcome variation for the business owner. The thing that's always a factor, of course, is the size of the transaction. And if we consider for a minute a gold service level, and we imagine a work fee roughly $50,000, the success fees that I'm seeing in the market vary from about 8 to 10% for a transaction under $5 or $10 million. I'm seeing about 6 to 8% for sales in the $10 to $30 million range, and 2 to 4% in the $100 million range. And again, this is information that I develop more fully on my blog. But there's a wide range in these numbers. And I just yesterday was talking to a firm in Silicon Valley, and I was surprised they were getting quoted about double what I'm showing there. I'm currently working with a company on a $500 million transaction, and we're out engaging one of the largest banks in the world, and I'm seeing fee quotes in as high as 4% on a $500 million transaction. Again, a lot of other considerations, a lot of range, but these are just kind of general guidelines. It's really a distribution, and this is kind of in the center of the distribution of what I'm seeing for fully marketed transactions and gold service levels. So if these seem high, remember, this is the upper left quadrant. This is the most work and the highest service quality. At the lower end of the number of prospects and the quality, you can divide these by almost 3 or 4. Another component, our industry, everybody who's in the industry knows, but for the benefit of the business owners who are on the webinar, there's always a 2-component fee in our industry, and there is an amount that is paid at the outset that is a guaranteed amount. As an indication of how immature our industry is, we don't even call it the same thing. It's often called a retainer, a work fee, or an engagement fee. What I'm seeing is that some firms consider this a prepayment on the success fee. Other firms consider it an additional amount, and it's important for the business owners to be clear on which case they're being quoted. And this typically ranges from $5,000 to $15,000 a month, and a lot of times it's capped at a certain size. For the $10 to $100 million transaction sizes, I'm often seeing it capped at $50,000 to $100,000, but increasingly it's not being capped. Increasingly I'm seeing it's just a straight monthly amount without a cap, and that recognizes that some transactions require a lot more work to get ready. Another interesting element in the M&A advisory fee conversation is this success fee formula. And so what I'm saying there, and I'm only going to touch on this at a high level, is that the amount of the fee is some formula based on the total transaction value. And when I've been talking about 6% or 7%, what I'm talking about there is as a percentage of the total cash equivalent transaction value. What's a surprise to me is that some firms are still using the layman formula for M&A. And that's a real surprise to me because, number one, that was developed by Lehman Brothers like 100 years ago specifically for financings. And it makes a lot more sense for a financing, but for an M&A transaction, it absolutely does not optimize the alignment between the M&A advisor and the sellers. And it's surprising to me, and I think it says a lot about firms that are still using layman formula. The most popular formula that I'm seeing, probably about 80% of cases, is a simple fixed percentage. In other words, 5% of the value or 10% of the value. In other words, a linear relationship between the transaction value and the M&A advisory fees. And some agreements, and increasingly now, are including accelerators. And what that means is that the higher the value, the higher percentage fees are paid. And that recognizes the alignment that Lehman Brothers formula lacks, and that recognizes that for a gold service level, you're going to get more for the company. And some M&A advisors are now building formulas that are kind of the opposite of layman. There's some challenges, I believe, with that. I think there are some risks that have to be carefully considered. One of them is the asymmetry of knowledge during the negotiation, because certainly the M&A advisor knows more about the valuation than the seller does. I think there's also some imperfections in setting the point of inflection where those fees increase. And so, in my opinion, I think that the majority of our market has it right. I think a simple linear percentage is the optimum trade-off between the alignment and the simplicity. But I do applaud some firms that are thinking that there's an even better way, which is to create a higher percentage at higher values. Another interesting change in our industry in the last 5 or 10 years is that minimum fees are becoming increasingly popular as the industry has heated up. And a minimum fee can mean different things. You've really got to be careful when you read the contracts. Some minimums are that the amount of the fee will be at least a certain dollar value if there's a transaction. Other minimums are that there will be a certain fee paid regardless of the outcome. In other words, they're essentially a work fee, engagement fee, retainer fee type fee, but paid at the end rather than at the beginning. And these can be in the millions of dollars. Again, this transaction I was mentioning a minute ago, this $500 million transaction, we're being indicated minimums in the millions of dollars for that transaction. And I think that when you see a firm asking for a large minimum, it's clearly conveying something about their belief of the probability of success. So I think that's a really important indication when you're talking about a total fee package, to think about what it is that you're learning about the M&A advisor's perspective on your transaction based on the size of that minimum fee. It could also simply be an indication of how busy they are. When a firm is fully busy, they might try to reduce their business risk by getting the seller to essentially guarantee them an amount far beyond just the retainer or work fee. So in summary, I think whenever you're talking about M&A advisory fees, you've got to consider all of the factors which cause fees to be different, including the transaction difficulty and risk, the number of prospective buyers that are being considered in the campaign. There's local market factors, there's macro M&A market factors, and most importantly, the quality of the M&A advisory service is the thing that really helps explain why the fee ranges in our business are so high. And again, I want to emphasize here in closing that this is all anecdotal. We do not have a big database anywhere that will allow us to prove these things or quantify these things. But this is based on a couple of decades of my fairly serious work on this, and I'm very confident that this is a reasonable perspective into the M&A advisory fees for the mid-market, especially in North America. So at this point, we're going to open it up to questions.
Thanks, Basil, for that presentation. I mean, that's invaluable information that you provided, and you know, as we've discussed, you know, not as many people, or there aren't many areas of information on this topic online or in print. So appreciate your openness and your willingness to share this information. It's truly appreciated on my behalf, and I'm sure the audience also appreciates it. So as expected, I mean, this is a very you know, interesting topic, and we're going to have some spirited discussions around it. We have a number of questions here that are coming in, so let's get to those questions. The first one that I have here, Basil, is how can a business owner differentiate between a bronze, silver, and gold M&A advisor?
That's a great question, John, and a difficult one to answer. I've literally had, I bet you I've had 100 conversations on this in my career, and the business owners don't have the knowledge of how the industry really works that they would ideally need to be able to make that assessment. And so there's really two parts to the answer. One is that most successful business owners have good instincts, and those instincts guide them in all of the transactions that they do in business, everything from hiring a new employee to negotiating with the big buyer for the product. So that's one thing that they can sometimes rely on to help them. But the other part of the answer is due diligence. And I strongly recommend that any business owner that's thinking about selling their company should have, you know, detailed conversations with at least 3 firms. And, you know, ask some difficult questions. Ask to, you know, speak to past clients. And, you know, in this day and age, which is a wonderful new time, everyone has a much higher profile than we did before. And through things like LinkedIn, it's often possible to get conversations going to help assess the quality of individuals and firms that we couldn't have done 10 or 20 years ago before we were all so connected. So diligence and instinct are the best answer that I can provide.
Okay, great answer there, and obviously tough to provide really quantitative information on differentiating between bronze, silver, and gold, but I think that's a useful structure and criteria for determining that. Okay, another question here, and we have a few of them kind of in the same genre. So what number is actually used to calculate success fees? So i.e., is it total transaction value? So let's start there on what number is actually used to calculate the success fee.
It's a very good question also, and one that business owners should be very careful in understanding before they sign an M&A advisory agreement. The short answer is it's the total cash equivalent transaction value. But that's a lot easier to say than it is to calculate sometimes. And if you look at a typical M&A advisory agreement, there'll be a whole paragraph. I've seen it be as much as the whole page describing all of the things that can be included in that calculation. For example, a lot of times in a transaction you'll see high consulting contracts paid to the business owners or founders over a period of years. That's done because in certain types of transactions that can be very tax advantageous. And it's not wrong, it's just a way of looking at it that optimizes the tax over the medium term. And so, you know, one of the things that you would typically see in the calculation of the total transaction value would be employment or consulting contracts above market. Now that gets to be really complicated because now you're trying to think about what's the market value for that service. As just one example. Other times you'll see, used to be popular a few years ago to include non-compete payments. I think it's pretty easy for most people to agree that that's part of the transaction value, but from a strict contractual perspective, there might be an argument that that's not included as part of the sale of the company's assets, especially, or shares. So there's a long list of things, but the short answer is it's the total value of the transaction that the success fee is calculated on.
So in your kind of experience, would that include assumption of debt? So say if a purchaser assumes a certain amount of debt in a transaction, I mean, that also is included in that total transaction value?
No, the debt, usually when a company is valued, it's valued on a debt-free and cash-free basis. So just so that we can be consistent in comparing one company to another, and just so we can be consistent in our language, valuation most often, but you've always got to check the fine print, most often it's a cash-free, debt-free basis. And for an M&A advisor's fee, it would be on the total enterprise value, which means that you're not considering the debt or the cash.
Okay.
A lot of M&A advisors, by the way, will want to get paid on the cash. There are quite a few cases I've heard where a company had, let's say several $1 million of cash in the balance sheet, getting paid to sell that cash. I think a business owner should think carefully about whether or not that should be included.
Okay, and on a related question to that, so if there are some sort of contingent payments, such as an earnout, how do you deal with that that type of, I guess, compensation or consideration in the payment of success fees?
A really important consideration because the industry is not consistent on this. Some M&A advisory fee engagements will specify that the M&A advisor's success fee is paid at closing on the total cash value of the transaction. And the reasons for that are really clear. I mean, first of all, it's simple, it's clean, and to do anything else is quite problematic because when you sell the company, the M&A advisory engagement is usually with the company. And so the company that's being sold, in the case of an asset transaction, could literally disappear. And so the whole M&A advisory contract gets into a very indeterminate state post-transaction. So, the first reaction of any firm is, we don't want anything to do with that. But if you think about it from the customer's perspective, think about it from the client's perspective, there's a lot of work that needs to be done post-transaction. And I believe that the more fair way to treat the clients, the business owners, is to say that the payments to the M&A advisor are made when the shareholders receive the cash. So in other words, until the money is in the shareholder's bank account, I don't believe that the M&A advisor has done all of the work that they should do. And so I believe in all of the transactions we do, it's as received and in the form that it's received. And sometimes that means shares. Sometimes what that means is that if there's a share component in the transaction, then, strictly speaking, looking at the contract, it means that some percentage of those shares are going to go to the M&A advisor. In most cases, though, what I find is that there's a pretty short negotiation that can happen, and usually somebody else will be more interested in owning those shares than the M&A advisor. And if the shares are any kind of valuable commodity, it's usually a short negotiation to find somebody who will trade cash for those shares. But the principle, I believe, is important, that it should be as they are paid, as the shareholders are paid, and in the form that the shareholders are paid.
Very interesting. So there's a few questions just around termination fees or break fees. So how often do you see termination fees in deals? and how much typically are those termination fees?
I don't see termination fees as often, but they're in the same category as the minimum fees. So what's been happening is the business is getting closer to capacity. The firms are wanting to optimize their own profitability, so they're trying to use contractual elements to ensure that they're going to be getting a lot more than just the engagement fee or the retainer fee. And so these break fees are often structured so that if the M&A advisor brings a transaction to the owners and the owners say no to the transaction, then the M&A advisor gets paid perhaps something less than the full success fee. The challenge with that is that there's a lot more to a transaction than just the value. A challenge with that I would see, for example, would be, let's say there's an offer that meets the headline price, but it has terrible terms. It's paid out over 20 years if the company hits targets. So of course the business owners would be very reasonable in saying no to that, and I would question whether or not that deserves to have a percentage of the success fee paid because the owner said no to that. I think that in this business there's an alignment between the sellers and the M&A advisory firm that's important. And I think that the job of the M&A advisory firm is to bring offers to the shareholders that they will accept. And if it doesn't happen, then there's a wide range of reasons why it didn't happen. But if it didn't happen, then I think the loss of value there should be borne in percentage. And it's the percentage is the success fee percentage. So again, a very important philosophical difference between different firms and different fee engagements that are out there in the market.
Mm-hmm. Okay, and another question that we received, and you and I have talked about this before, Basil, but sell-side fees, are they impacted by prospective buyers or investors that use buy-side advisors?
We see two-sided M&A advisors in about a quarter or a third of the transaction. So about a quarter or a third of the time, there are professionals working on the buy side of the transaction. And I don't see a difference in the sell-side fees depending on whether or not there are buy-side advisors. And part of the reason for that is that the buy-side advisors are going to show up much later in the game than well after the engagement was signed. It's arguably an easier transaction to do if there are buy-side advisors. But on the other hand, a lot of the bigger strategic buyers now have very large corporate development departments full of professionals that buy companies all day long. And you could argue that they do at least as good a job as the buy-side M&A firms. So while there's a big difference between the size of sell-side and buy-side fees, I don't see the sell-side fees being impacted, at least I can never recall them being impacted by the presence or absence of a buy-side advisor.
Okay, expanding on that a little bit, how do you feel about splitting fees between advisors? So you have a deal in the market and another advisor comes to you and says, hey, I have a potential buyer. Are you open to splitting fees with that advisor, or what are your thoughts on that?
I think it's a very good idea. The industry that we're working in is getting much more interesting every day, if I can use the word interesting, to say that it's also getting more complicated. The technical depth required to sell some types of technology companies, for example, can be extremely steep requirements. Another factor, and you and I were talking about this, is that it seems to me that in the last 12 months, the Chinese buyer appetite for certain types of companies has exploded. And in our firm's philosophy, if we had a situation where there was a real probability of a Chinese buyer, I would be I'd start looking for an M&A advisory firm that had better language skills, better cultural affinity, and probably a better geographic location to help us with the possibility that the ultimate successful buyer would be a Chinese company. And I find that in this day and age, most of the boutique firms are quite happy to talk about a fee-sharing arrangement. And I think that the ultimate decision there should be what's best for the client, what's best for the business owner. And I think, bringing in specialized talent, whether it's deep technical knowledge, prior transaction experience, or a different cultural, linguistic, or even time zone capability, all of those things make good sense to me, and I think are highly desirable from the client's perspective.
Great. Well, we have a few questions around buy-side fees. So, I mean, the information that you provided was specifically related to sell-side transactions, but can you provide some of your knowledge and experience on buy-side fees and how they differ from the sell-side fees that we've been discussing?
It's interesting that in the market, buy-side fees, from my perspective, seem to be around half to one-third of sell-side fees. And I think one of the reasons for that is that on the buy side, they're very often dealing with a smaller number of prospects. A firm that might engage a buy-side M&A advisor might have a well-developed idea that they want to acquire one of these three companies. And so the research component of the engagement is often much lower than it is on the sell side. And I've had an interesting range of conversations with firms that do buy-side work about the probability of success. There's some people who would say that they don't do work on the buy side because too often they end up with a situation where there isn't a transaction and they feel that the firm that engaged them wasn't 100% committed to the process at the outset. And so they felt that they didn't earn the success fee because there was less than a full commitment at the outset. Usually on the sell side, when you've got an owner and he says, I want to sell the business, usually there's clearly identifiable motivations for doing that. For example, I'm going to retire. It may happen, but I've never had somebody who changed that decision once they've made it. And so there's a difference in the probability of success, but in general what I'm seeing is a half to a third on a percentage basis for work on the buy side, and a slightly higher number of cases where it's just simply hourly work on the buy side.
Okay, a few other questions coming in here on just the payment of retainer fees. So what percentage of deals that you've seen actually pay retainer fees? And a follow-up to that as well is with the retainers, are they usually credited against the success fees? I think you had mentioned this through your presentation, but maybe if you can just dive into that topic a little bit here.
I see the retainer work fee, engagement fee, being applied as a deposit or a prepayment on the success fee in the majority of cases. But there's quite a few firms that consider it extra. And I can't prove this, but my perception is that that's increased as the market's heated up, understandably. I don't recall ever seeing an M&A advisory engagement that did not have a work fee retainer from a good quality firm. Whenever I've come across a situation where a firm was willing to undertake an engagement on a completely contingent basis, the firms have been trying very hard to break into the industry, or they had a huge surplus of talent that they were paying anyway and they just wanted to keep busy. So I think from a client's perspective, when they see something that's that far out of the norm in the industry, there's something important that's being conveyed there and they should listen to that very carefully.
Great. Well, Basil, we have a few more questions here, but just in the interest of keeping this to the hour and respecting everybody's time on the webinar, I think we'll end it here. I'd really like to thank you for all of the invaluable information that you provided for everybody. I want to thank everybody that's attended the webinar. I hope you found this valuable. I know that my discussions with Basil, I've personally found it very valuable in understanding more about M&A fees. Just from the number of questions and the comments that we're getting, this seems like a very interesting and desired topic. So Basil, I'm sure we'll have to go back to the drawing board and think about a follow-up presentation or webinar that we can do, maybe in conjunction with our M&A fee survey that we're conducting with Firmex. And just as a reminder, we'll be sending out a link tomorrow, so if everybody on this webinar can complete that important survey, we'll definitely consider following up with a webinar just to present the results of that. Basil, again, I want to thank you. This has been tremendous. I think, again, very invaluable information. And as of right now, we'll end the webinar and enjoy the week, everybody. Have a great day.
Thank you.